are the panel. We've got the crew. Matt's back. Jim, Heath is back with us, looking fabulous. 15 years to get back to where we are, guys. If we were to adjust this for inflation, we'd be talking NASDAQ 6,700. So, you know, I get where people are anxious, though, Jim, but golly, we're just getting back to the all-time high.
I actually think the 5,000 number is far more symbolic than it is, as you said, on an inflation-adjusted basis. It's a low number. My older brother can't drink tequila because of a bad experience. It doesn't mean it's a bad thing for you. But no, I think China cutting rates, M&A activity. You mentioned NXPI. You look at HP buying Aruba Network. You talked about IBM, putting pressure on them to take actions. And then you've got the central bank, European Central Bank, actually going to start their quantitative easing late this week. So the fact is, I do think there's other things that are pushing this market. So you can don't worry about NASDAQ 5,000 symbolically. Look at the fact there are a lot of good things going on in this market.
Next, real deal. I got to go to Jim Frischling on this because, Jim, first of all, you still long Staples?
I'm not long Staples. I was liking Staples, recommending, and actually even talked about this merger opportunity, but I'm not. I have no long position.
What happened?
Again, my money's in certain places right now, and I still recommend it, but I still like it. But again, I'm not long Staples.
Well, what about Staples as a lender?
Look, I think it's this to me is a little gimmicky. Although I don't think it's going to hurt them. Do not think Staples is launching that branch we're going to be walking into. This is a relationship they formed with Lendio, a free online company. I think they're a filter and a feeder, I should say. Again, I don't see this being really material to Staples either way, personally. But again, I don't think it's going to hurt them. They're not getting distracted from their core. They are trying to direct people to these service providers.
It's a business development tactic.
Yep.
I mean, they are exactly what Jim said. They're filtering clients to them. I mean, on average, the Federal Reserve came out with a study that said, on average, small business owners spend 33 hours just filling out paperwork.
So now they're overdoing it by being overly conservative on the lending side.
What do you make?
Can you blame them, though? I'm sorry. The CFPB,
no,
the
SEC,
Dodd-Frank,
absolutely.
they're under a mountain of litigation, so I'm not a defender. But the fact is, I do believe that the pendulum has shifted too far. I think greed will bring it back. Banks are still doing some lending.
Having said that, then, do you think something like a Dodd-Frank has to eventually get done? There's something to be said about understanding what the rules are before you go out there and start lending money.
I mean, on the one hand, I think banks are actually, particularly some of the small and mid-sized banks, are going to be really interesting lenders in this space. There is a wealth of this peer-to-peer and B2B businesses going on. I will tell you that a lot of people are getting concerned that there's a lack of due diligence, a lack of scrutiny, and that this could become actually somewhat of people are relying on the credit process of these kind of unknowns. It reminds me a little bit of when people bought for the credit rating, bought assets based on credit ratings, didn't do their own due diligence. A lot of loans are getting done, not a lot of diligence through this online marketing. I'm laughing because I think I went a little, not boring, but Wells Fargo. And the reason is they are still one of the top 2 or 3 largest small SBA lenders out there in the market. And they're kind of the non-Wall Street bank. Huge bank, but they're the ones staying away from a lot of the asset classes and a lot of business cause trouble.
There's no doubt. They're starting to distance themselves. I think
and they're lending.
I think not just economically, but from a public relations point of view, I think they're winning that big time, and I think it's going to be great for the stock. Do you worry a little bit, Jim, about poor execution, the fact that they keep missing the bottom line?
Yeah, actually, I'm okay with that right now. There were 2 things that concern me, and I think the companies address both. One is the concentration risk with GM. But you talk about the backlogs, and 70% of their backlogs are non-GM. 2 is the company was, I think, historically has been a little over-levered. But the fact is they've refinancing debt. I think the cost of those transactions hurt their earnings a little bit, their margins a little bit. But going forward, lower interest rates for them over time. So I think they've addressed the 2 concerns I would have.
Non-GM business approaching 50%. All right, let's talk about what you guys are looking for tomorrow. What's going to move the markets, Jim?
Matt touched on auto sales. I think this is a full week on the economic data front. Tomorrow's auto sales. End of the week is jobs. I think economic more than anything else. And oil could be, I think, a little bit of volatile.
Are we going to get a sign from the jobs market that this is less about the 12-year-old cars and greater? Could we extrapolate that it's about greater confidence, at least when people's on position, having a job and things like that? Or is it just a result of getting a car with no money down?
I mean, look, I do think the auto sector is getting aggressive in their financing. As for the job numbers, to me, it's a little bit binary. You either have a job and you're feeling good or you don't. But the fact is, I do think we're going to see a good jobs report, at least continuing the trend that we've been seeing.